Great. Thanks, Prashant and Parag. This was fairly insightful from understanding contribution of different factors to the performance of strategies at WhiteOak, as well as, of course, the big corporate news of HDFC Bank and HDFC Limited. So, Parag, since this is the first time we've got you on Quarterly Connect, and as questions are coming in, I'll take this opportunity to ask you the first one, which is the other big news which is on right now. So not asking you for a recommendation on LIC IPO, but in general, the insurance sector is been buzzing, and you've seen a lot of listings happening. The parameters which are used typically to evaluate investments in the insurance sector is a little bit different from the rest of the financial sectors. So if you can just throw light in terms of how investors and advisors who are on this call could evaluate the insurance sector and look at opportunities which come for investment within the sector.
Sure. Yeah. Thanks, Prateek. Like insurance is a completely different way of analyzing business. So what happens in life insurance particularly is that potentially you write a policy right now on anyone, right? Probably you give a protection insurance or any other form of insurance. And the risk, or you can say cost to the life insurance companies are two. One is the commissions you pay out to the distributors or anybody who is bringing in that person, and the biggest cost would be the mortality. If something happens to that individual, then you probably have to pay the entire sum assured. So that is what the tricky part is. So basically what happens is that you need to make the assumptions of person dying, I'm sorry I have to say that, at one particular interval, and basically arrive at the profitability. So entire metric is different. You have to project the mortality. You have to basically take a NPV of the entire cash flow and understand where do you actually make money. So that is how the life insurance sector valuation kind of work. Overall, I feel the life insurance sector is in an extremely advantageous position. I mean, I can probably say with the guarantee that among the the audience what we have, most of us would be underinsured, or maybe a couple of us would be not even insured. So I think the opportunity is quite large. There is a lot of things to tap upon in the metro, semi-urban, urban. There are a lot of areas, a lot of individuals, businessmen, at least salaried and all people now started taking insurance. But think about the business community. Many of them have no insurance. So I think the opportunity is very large. LIC is a very good brand name. They have done very well across past few years. There are obviously challenges with the LIC like business model, that they are agency driven. So over a period they have relied heavily on the agency force. They haven't ventured into a direct mode or online mode, or probably tying up with large banks to sell insurance. So all those things remain a challenge, right? They are very behind in a pure protection term insurance, where private companies are doing quite well. So we have to see these two areas, how LIC performs over a period of time, to compete head on head with private sector insurance. But I think in a nutshell, the insurance as a sector is very promising.
Great. Thanks for your insights out there, Parag. For everybody in the audience, there is a button on the right-hand side on your screen which says where you can drop questions, any questions which you may have for Prashant or Parag, and we'll be happy to take that. Prashant, while I understand that as a philosophy, we don't talk about macros, and there are more. Our stock selection process is all based on bottom-up analysis and security analysis. But there are, there is a lot of concern in the audience, which some people have raised about some, significant headwinds which they're seeing. Of course, we've seen how markets tend to at times not really align with what the necessarily macro headwinds are, and COVID was a prime example where we saw markets running even after knowing how serious the challenges were. But any broad things which people should be watching out right now from a macro view, or is there something which one needs to then do to protect portfolios?
See, so it's not that we don't think about or worry about macro, but we think of macro or worry about macro to far lesser degree, I would say, than most others. And we don't think of them as source of return generation or alpha generation. So that's one big difference. It's a nuance compared to, say, other, compared to certainly retail investor, but oftentimes also many well-informed investors and professional investors who think of macro as a source of return or alpha generation. We think of it as a source of risk, and how we can, because we don't believe it's like a coin flip. Coin flip. If you play a game where you win a million or lose a million based on any coin flip, then that's just a source of risk. There's no value you can add in predicting coin flips. Like, you can do a PhD in coin flipping and yet be no better than layperson, as I've said many times before. So we think of these as sources of risk and see whether we can intelligently mitigate risk in the portfolio. What I mean by intelligently mitigate risk, there is a non-intelligent way of mitigating risk, which is just index. And for us, when we talk about performance, is relative performance compared to the benchmark. So the non-intelligent way, or blunt or dumb way of blunting the risk, would be to make the portfolio more like the index and hug the index. An intelligent way of mitigating the risk would be how we can reduce the factor risks while safeguarding the alpha potential of the portfolio. It's not always straightforward and not always possible and you cannot eliminate the risk at any time, but to a certain extent we try and mitigate, and that's how we think of the macro risk.
Sure. So Parag, again, we've seen as when Prashant presented the slide on portfolio construction, the largest weightage within the portfolio is in the financial space, right? And we've said in the past that financials is not one homogeneous sector, right? It has multiple elements to it. You did speak about insurance. We've spoken about the large bank out there. But if you would want to give an overview or flavor of, we've always been very selective about how we've looked at the NBFC space and our exposure in some of the other companies, but would be great to understand because that's the largest part of the portfolio right now.
Sure. So, see, as Prateek, rightly mentioned that, we own mix of everything. We have, good banking exposures there. We have two good NBFCs as in our holding. One of is performed quite well, Cholamandalam. We have insurance companies. We have exchanges. We have also, CAMs in our portfolio, which actually is a play on the asset management companies in India. So it's quite different. See, look, I feel banking as a sector or a finance as a sector as a huge opportunity to grow. So I can tell you, when I joined this industry around 15 years before, PSU used to account for 75% market share. Currently, they are down to 60. Every year, on an average, they have lost 1% market share, right? And those entire market share is up for a grab for every private companies, which is very well managed. Credit as in sector in India, if you look at as a percentage of GDP, it is quite underpenetrated. So here is the sector where, let's say the nominal GDP tends to grow at anywhere between 10 to 12 odd percent. The credit market, the overall credit market in India can definitely grow at 1 or 3% better than the nominal GDP. And upon that, you have private sector, which can grow better at a cost of PSU bank. And within private also, you have good companies which are tech heavy, have done very good underwriting, can definitely grow or even better than the entire private banking system. So here is the opportunity, and these opportunities for the multiple years for a decades to come, right? So we are very excited about banks in our portfolio, the NBFCs in our portfolio. Good thing about them, even in the current short-term environment of rising interest rate and inflation worry which we have, the banking, if you look at Indian banks are so beautifully placed that on the liability side, you have anywhere between 40 to 45% CASA. The cost of funding on that side is completely fixed. And on the liability, on the asset side, you have your loans, which get repriced as the interest rate goes up in the economy. So in a environment where there is a rising interest rate, the banks actually benefit from them. The inflation gets naturally built into your loan growth. So let's say a vehicle which is selling at 100 rupees right now, 2 years down the line, it's going to sell at 110. I'm going to lend at 110 as a bank or as an NBFC, right? So I think the credit cost, which is a very important factor, the NPAs and all have undershoot, and I think it's going to give you a lot of leeways in next 1 or 2, 3 years. So I'm quite confident on the banking sector as a growth in terms of margin, in terms of credit quality. So I think good days are yet to come for banking sector for the next 2, 3 years.
So heads you win or tails you win, right? So Prashant likes to give analogy of tossing a coin at every point. So I guess banking sector is the same thing, whether rates are going up or they're coming down. On one side, you may have a treasury impact. On the other side, you have repricing, which is again leading to increase in NIMs or something. So, yes. So I guess as you rightly say, Parag, good time is there. Just a couple of other questions which are coming in. Prashant, if I may ask you. The favorite commentary has been around FIIs, right? We've been one of the largest recipients of FPI flows into India, but there seems to be this general, news around FIIs being large sellers in the market. Do you see that's going to continue? And if so, what impact could it actually have on markets?
Certainly. So see, while the reported figures in media and on by exchanges or SEBI are at FII aggregate level, one needs to importantly understand that there are several sub-segments within that overall level umbrella figure. And we are, in our assessment, obviously that individual sub-segment level data is not available, but a big chunk of the what is FII investment maybe totaling about $700 billion in India. I would hazard guesstimate that 2/3 of that, roughly 2/3 of that, or call it 500 billion of those, likely comes from multi-regional funds. So GEM Fund, Global Equity Fund, Asia Fund, and so on. Whereas only 1/3, or call it about $200 billion, and nobody has precise data on this. So these are guesstimates based on what we know through market intelligence, if you will. About $200 billion is India dedicated money. So my conjecture or my guess is that most of the outflows have taken place from multi-regional funds. What happens is, if let's say China has, and Russia problem has happened, China there have been problems. So if someone in America, Joe Schmo in America, or a lot of Joe Schmoes in America, who is one of the largest pool of assets for global emerging markets, if they reduce or they sell global emerging markets, and there is, let's say, $2 trillion of global emerging markets funds, and there is 10% outflow, let's assume, which is $200 billion. India is 15% of global emerging markets, right? So 15% of $200 billion would be $30 billion. Now, even if the GEM fund managers were to reduce less from India and reduce from other, still we would get somewhere between 20 to $30 billion of outflow, because you cannot just not sell India, otherwise India's weight in your portfolio would balloon. So I think it's largely that, and that gels well with our experience, because we right now, while we are about to launch GEM Fund, as of today, we have 100% of our assets from foreign investors, which is about $4.5 billion. That's all India dedicated money. And we have seen net inflows year to date, as well as over the last 6 months, 12 months, or ever since these outflows have been going on. So at least we don't, and it's not just, obviously some of our inflow is competitive wins, coming from other managers on the back of performance that the team has delivered, but we can see that some of these inflows is also fresh money coming into India. So that gels with what we have been saying, that a lot of the outflows are related to global equity funds or global emerging market or other multi-regional funds, overall reducing their global exposure due to what's been going on in Russia.
Sure. So just another point to that, which has just come up. So I know the team had prepared a paper earlier in the year around attractiveness of India compared to other emerging markets. In the scenario where what we're seeing, implode in Russia or some of the challenges which China has faced, how is India compared? How are you finding India compared to all the other emerging markets? Also quite relevant, as you just mentioned that WhiteOak is looking to set up a GEM strategy during this quarter. So how do you see this whole comparison of India within the EM bucket?
Certainly. See, again, just as I say, when I was managing GEM, I would always get this question as well, and we'll soon start getting this more often as well. But just like we say that, from a sectoral perspective, you cannot top down say that XYZ sector is going to do better than ABC sector, X or large cap would do better than mid cap or so on. These are all mere talk of little value. So ex ante, it's reasonable to assume that going forward over any reasonable time periods, all country markets, be China, India, Mexico, Korea, or anything in between, are likely to perform in line in dollar terms. And if you ask me a point estimate, that should be in line with nominal GDP growth rate of these countries, which is around mid-single digits, 5 to 6% dollar growth, right? Which in rupee terms might translate to, call it around 10%. What makes different emerging markets different is the composition of the emerging markets. In certain countries, there is greater stock selection opportunities. Just as we talked about the funnel of opportunity, we had the large cap versus small cap and the sectors and governance and whatnot. For different reasons, including some of these that we talked about, certain countries like India present a richer opportunity set for stock selection. Other countries like China, A-share also is fairly inefficient segment of the market. On the other extreme, there's a country like South Africa, which has had this Anglo-Saxon model of institutional investment management for donkey's years now, for many decades, or nearly a century. It's more efficient market. So there's less alpha potential over there. So that is what I would first and foremost say. Having said that, from a macro perspective, and you pointed out, Prateek, the newsletter that the team has written, December newsletter, would encourage everyone to take a look. We've got some very positive feedback from global investors. It's called the India Premium. So India has historically always traded at a sizable premium multiple to the global EM average. And we've talked about why there may be good reason to believe so. Just like if a certain sector, let's say consumer discretionary sector or healthcare or some such sector trades at a higher multiple than another sector, say commodity sector, does not mean one is overvalued and another is undervalued. There might be characteristics, or within a sector, we all know certain companies trade at a big premium to other companies. Doesn't mean one is overvalued, the other is undervalued. There might be characteristics, including corporate governance. Within consumer staples, there are certain companies which trade at 50, 60 multiples on cash flow, I'm talking about, whereas others which trade at much lower multiple, because maybe corporate governance is the differentiator. And the same, so if at country level such differences can exist, even at country levels that can exist, and this paper goes into that. And one of the things that paper highlights is that countries with democracies, democratic governments worldwide have tended to always trade at a premium to countries with authoritarian regimes. And this year probably justifies the market's behavior over long period. For donkey's years, people have been talking about why Russia trades at 5 multiple, 4 multiple, and this is cash flow multiple as well, right? Many companies that traded should trade at 2 to 3 times cash flow multiple. In India, similar sector, the companies trade at higher price to book value. And in Russia, they would trade at 2 to 3 times cash flow, not earnings multiple, but cash flow multiple, because of major governance related questions, right? And you didn't even know sometimes. And when I would first see such a company, would be excited, but then you can't even figure out who really owns the company. The ownership structure is so complex, right? So now we know why Russia always traded at such a steep discount. And that is true for most authoritarian countries because of lack of adequate property protection rights, and excessive concentration of power in the hands of one individual or select few, and oftentimes arbitrary exercise of those powers is what investors consider as a heightened risk, and they've been historically proven right. And that's why they trade at a discount. And democratic countries, not only India, but other democratic countries, you'll see, have consistently traded at a premium. Not that one is undervalued versus the other, just like government-owned companies in India and everywhere in the world trade at a big discount. And this is also highlighted in the paper, by the way, that the team has written. Government-owned companies trade at a big discount to private sector companies. Right? Doesn't mean that they're undervalued or overvalued. They may be appropriately valued. We've never said that government-owned companies are overvalued, or in general, poor governance companies are overvalued. As we were talking earlier, they all may be fairly valued, but fair value for a poorly governed company may mean a very low multiple. Whereas a well-governed company might mean a higher multiple, and the same is true at the country level.
Sure. Thanks for that, Prashant. And I would encourage everyone to download this paper. You'd find it on our website, whiteoakindia.com. Prashant is referring to this India Premium paper. There's another interesting fact on that just because when you look at an example like China, which was growing pretty fast, that does not necessarily translate into a higher price earning number. So there are many similar facts which are covered in that paper, and would encourage all our audience to really go through that. Just one last question, Prashant, which is coming, and this question was asked even during the last time when we had the announcement of the asset management company. Now that you've set up an emerging market team out of Singapore, there is an asset management company which has been set up in India, and also the PMS business. How is the investment team been bifurcated, and are all parts of the businesses getting enough investment expertise within the team? Of course, we had announced Ramesh Mantri, who would take over as the CIO, for the asset management company. But would be great to for everyone to just get an idea in terms of how the entire investment team is being structured in this new offshore, onshore PMS mutual fund business, which WhiteOak is setting up to.
Certainly. I assume it is coming from one of the due diligence persons from one of the distribution partners, as we have gotten this and explained it. So this is somewhat of a longish answer. Given that we're already at the tail end, I'll try to summarize it, but happy to go at greater length in one-on-one or other formats. But see, basically, first and foremost, it's not the first time that I have built large team or managed or overseen large teams. In fact, most of my career have been used to working with and leading or being in senior leadership roles of large teams. So I started my professional career in '98 in State Street Global Advisors in Boston, US, and then soon moved to Goldman in 2000. And in 2004 was senior PM and co-chair of investment committee of a team of 20 plus people over there, US growth equity team managing nearly $30 billion. So I have worked at senior most levels in large teams, overseeing the process of the investment process. Built the India team in 2007 for Goldman to start the business. And then in 2013 became head of global emerging markets, where again, I had 20 plus team. Several of them I inherited. Most of them I inherited, which is even more challenging than a team that you have built. Today here at WhiteOak, we've built the team, as you saw earlier, of over 25 people now and increasing from there. These are all cherry-picked individuals, if you will, by the team members, including myself. It's a very elaborate process. So these are people who are in their own right, have strong caliber of investing at present, as well as strong potential to evolve. As you know, nobody is a complete investor. We all continuously learn. Parag is learning every day, I'm learning every day, and we all interact with each other. It's a game, which is a game of never-ending learning, right? So it's a very strong team where we're learning from each other. And I would say that larger team that we have today provides a stronger environment of learning, a more powerful environment of learning than a smaller team. And having the resources, global resources, I have often shared with several of you. I feel particularly having had the luck or good fortune of managing money in the US, where I saw the dot-com bubble during late 90s and 2000. And in companies like Google, I was day one investor, and having seen and made many mistakes. While I'm pointing out some Google as a great success story, but have made mistakes as well. But that experience, that learning helped me tremendously to first, when I was managing global emerging markets, because in the mid-teen, 2013, 14, 15, 16, 17, those were the years when a lot of these companies, including Alibaba also was day one investor, right? Now it's run into trouble, but at that time it was a different story. So the experience of investing or not investing in names like Google and Alibaba, Google and Amazon and other eBay and Yahoo and whatnot, helped in the investing or not investing in companies like Alibaba, Baidu, Tencent, and so on in China and Korea, Naver and whatnot. And now that experience is helping when investing in companies, similar companies in India, or not investing, be it Nykaa, Policy Bazaar, Paytm, or many others. Not that we'll make 100% right decisions, but certainly having had this experience has certainly helped in the decision making. And similarly, so as we, so if we don't do GEM as an example, then over time, this benefit would become stale and erode, is my feeling. By starting GEM now, we are bringing in experts, industry-specific experts on board who already started contributing, by the way, to discussions on the team. I'm just trying to remember, just recently we were discussing, and it's not an IT company, it was some pharma company, where someone who has followed a similar company for long in China was able to provide some useful insights to the team discussion, right? So building that has the benefit of having resources, looking at around the world and contributing those insights to discussions about Indian names as well. And for the team members here to build similar, benefit that I talked about of having looked at around the world over time and help them become stronger investors as it's a continuing journey. So I think from the pros and cons, the pros far outweigh the cons. Having had the experience of managing large teams, I have the experience of limiting the cons, if you will, while harnessing the pros, is how I would think. So you can't just throw 25 people and expect things to, work well. But you have to select the right team members, build the right environment on the team, right? a healthy environment of or what we think of investment culture, which is what differentiates us from everyone else. In that situation, a larger, well-resourced team contributes to everyone's learning and contributes positively to every portfolio strategy. Sure. And if I were to share, my performance of India portfolio is markedly better after I started managing GEM strategy at my prior firm than before managing GEM strategy. Because I learned a lot of lessons. One of the lessons that I've shared, like I realized around the world, government-owned companies were poorly governed, right? So it had an impact on my expectations from government-owned companies in India as well. So these are insights that from actual practice only you can learn.
No, great. Thanks, Prashant, and thanks, Parag. I think as we get into, WhiteOak is going to complete 5 years in the next month or so, and which will in a way coincide with the launch of the GEM strategy at WhiteOak. In a way, the part after having brought India to the world, as one would say, it would be great to get some parts of the world which WhiteOak would start managing. So just to summarize some of our discussions which we did today, right? Prashant did mention the fact that while there are broad macro headwinds which are seen, they're not necessarily impact portfolios which are more bottom-up driven in terms of security selection. At WhiteOak, we have faced some performance challenges over the last 3-4 months. Having said that, this is not the first time. The most important thing is we know what are some of the factors which contribute, which include how some of the underweight sectors have done well as the underperformance of or small and mid cap versus the large cap. Parag did give some very interesting insights on the HDFC Bank and HDFC Limited merger, and also no recommendation but recommendation on the insurance sector and how it's a great great place, and there are going to be a spurt of new listings which one could expect out there. Finally, an overview of emerging markets and how WhiteOak is doing in that. So with that, thank you everyone again for being part of this call. Sorry, Prashant, you wanted to say something?
No, I just wanted to, I was remiss. I want to take the opportunity also to thank everyone, not only for joining here today, but also want to thank everyone for the confidence and trust they've reposed in the team's ability to manage their portfolios, investments. Thank you so much, everyone, and look forward to interacting next quarterly call. Back to you, Prateek.
Thank you. Thanks, everyone. Thank you.
Thank you. Thank you, everyone.